You want to retire a multimillionaire, this is the video for you. Now, when it comes to ETFs, there are a lot of good ones. There are a lot of very, very bad ones. Even the Bitcoin ETF that a lot of people are really going and investing in. But in today's video, we're going to be looking at 5 SPDR ETFs that will help you retire a millionaire. That is right. When you look at ETFs, they are exchange traded funds, and the SPDR ETFs are one of the best in the market. Now, if you're very familiar with the Vanguard ones that I covered a little while ago, the SPDR ETFs are run by S&P Global, and we're going to look at the 5 biggest ones that they have, or really the most competitive and the most growth factor ones that we do see, starting off with number 1, which is the SPDR S&P Semiconductor ETF. Now, of course, this is a big one if you're looking to get into kind of the AI space. They have a majority of the companies. Now, the ticker symbol for this one is SCHD. Got to be real particular in that. Now, of course, this one is just semiconductor. It really focuses on an ETF in a very specific sector if you're looking to. Now, since this has been brought around or launched in 2009, it has an annualized return of 22.3%, which is the top performing ETF that we have seen. That is coming from SPDR at 22%, which is insane because even when you think CDs, savings, everything of that nature, 22% return year over year. This is the annualized return. So again, good years, bad years, we're still seeing 22% out of this one. Now, the fund's top holdings are, of course, some of the big giants. We have NVIDIA in there, we have AMD, we have Broadcom, we have Marvell Technology, but it also holds a lot of the lesser known semiconductors, which really round out this fund. This ETF has a very low expense ratio of 0.35, which means for every $10,000 you do have invested, you're paying 35 bucks in fees, and that is it. Now, when it comes to the average ETF expense ratio, it runs about 0.5%, about a 0.57. So really it is significantly below, but it is not below some of the ones that we see in the Vanguard lineup. But this one still with a 22% return is absolutely crazy. Now, getting out of the semiconductors, but kind of in the same realm, we look at the technology select sector, the SPDR ETF. Now, this ticker symbol is XLK. Now, this one focuses on technology, not just the semiconductor technology. Now, of course, this has the tech giants. When you look at Microsoft, Apple, NVIDIA again, Advanced Micro Devices, Cisco, Salesforce, really to break down this top 10 list, they are some of the really big companies. Now, of course, with it being in the tech orientation, it has a very, very heavy compensation of Microsoft and Apple. So Microsoft is at 22% of this portfolio. Apple is at 19% of this portfolio. So there is a big, big focus on those large tech companies with a massive investment in there. Now, with this, dividend yield is a 0.7 because we know tech stocks are a lot about the growth factor, not so much about giving back. And the expense ratio on this is a 0.09, which is awesome. Meaning for every $10,000 you have invested, you pay 9 bucks, which is crazy. But the big thing since 2009 is this has delivered 20.4% annualized return. That is right. It is kind of crazy to think in 15 years, we have seen over a 20% annualized return, but we know tech has been just absolutely crushing it. Now, this is one that I like to get into. This is the SPDR S&P 500 Growth ETF. Now, very similar, this has a big array of growth stocks. And again, similar to what we see from like the VUG, the growth fund that we do have for Vanguard, there's no surprise. Of course, the top holdings in this are the Magnificent Seven. So we have Microsoft, NVIDIA, Alphabet, Amazon, and then of course, Meta, Tesla, some of the, again, largest players that we have here, but it's at a much lower percent. So when you think of the tech sector where we are running, almost 30% in some companies, this only owns 13% of Microsoft. We have 11% of Apple, 8% of NVIDIA, 6% of Amazon, 4% of Meta. So it is a little bit more of a broad market. And examples for this, it does have a lot of decent stocks from other sectors. The consumer stocks make up 14%. Healthcare and industrials are in there as well, holding a certain percent. So now you're kind of expanding your risk and really that mitigation. And of course, this one has been outperforming the S&P 500, which is kind of interesting. So when you kind of put the S&P 500, and again, this is kind of comparable to the VUG, that Vanguard growth fund, but overall, since its annualized return is 16.1%, it has outperformed the S&P 500, and that is because of the focus on those Magnificent Seven and the growth factor that we've seen within those stocks themselves. Now, of course, for me personally, I do not hold those individual stocks. I only buy ETFs, and I've done this for a multitude of years. If you checked out some of the other videos in our portfolio, it is about the ETFs, and that is really building the growth. Every now and then you'll have a one-off company that does exceptionally well, but when you're talking 7 years plus, the ETFs do incredibly well. And if you like the content that I'm putting out there, go ahead and subscribe to the channel when we get to the rest of these spider funds. The next one we look at is the S&P 500 ETF Trust. Now, of course, this ticker symbol is the SPY. And I believe, if I remember correctly, this is the oldest ETF that there is. I believe the SPY, if I remember, largest ETF trading by volume. Also, I believe it is the oldest. Don't quote me on it, but I think it is. Now, this fund does track the S&P 500. So again, very similar to where we are invested in the VOO. This is Spider's version of that S&P 500 that actually tracks it. Now, of course, when you look at market caps and when you look at the monster companies, again, Magnificent Seven, of course, prevalent in there. The Microsoft, the Apple, the Nvidia, the Amazon, the Meta, and of course, Tesla in there to round out those couple of really, again, mega monster market cap companies that we see. Now, it's really hard to ignore this because you have exposure everywhere. That's the big thing where, if you put money into, let's say, Nvidia, or you put money into Tesla, you're really subject to Tesla going up and down, depending on the sector, depending on the market, depending on the company itself. This is why, again, the ETFs are pretty important, because even if a sector where, let's say, AI has been booming, they're doing incredibly well, or, the energy sector is doing incredibly well, healthcare at a time, of course, COVID doing incredibly well, you're getting the best of both worlds. And even if a market is not doing as well, or it's kind of underperforming, the markets that are doing incredibly well can kind of pick up a lot of lag. Now, this, of course, this is one you want to set it and forget it. Like we said, when you're investing in the entire S&P 500, it has a 14.2% annualized return, which is kind of crazy. And of course, the fund's expense ratio is a 0.09, which is far below the average with the dividend yield of a 1.4. So not too great, but when you start getting into a monumental amount of money invested in these, it makes a really, really big difference. And the final one we're looking at here is the Spider S&P 500, the value. So we looked at the tech, we looked at the growth, we looked at the S&P itself. This is the value focus. So again, similar to some of the ones that we're seeing over in the Vanguard side, the Spider does have kind of very similar kind of builds. Now this, of course, is looking for more of the growth factor. So they're focused on compounded annual growth since 2009 is very solid. Now this does trail the S&P 500. So again, when you look at the growth side, it was overvalued, or you were making more money in there. The S&P 500 was kind of your baseline, kind of the beta. And then looking at the value side has been kind of lacking with the S&P 500. And of course, it is because it's not holding a majority of those very large stocks that we see within the tech side. The top holdings in this one, Berkshire Hathaway, JP Morgan, ExxonMobil, Johnson & Johnson, United Healthcare. So you can see this fund is fundamentally different with not only the percentages, but the companies that it is in. And of course, healthcare makes up 22% of this, financial services make up 19%, and dividend yield 1.7, which isn't really huge, but it is slightly better than those S&P 500. And the expense ratio on this is a 0.04, which is incredibly cheap. Again, that's most of the expense ratios that we see on those Vanguard funds when they go in there. So overall, Spider has some really, really solid ETFs, similar to what we see on our Vanguard side, and very comparable when you kind of compare them. So the compare and contrast can be incredibly difficult in these, but before you are investing in anything, I advise you, do your research, know exactly what you're going into, and really building out a 3 ETF portfolio or a 4 ETF portfolio, which I do use, which is a great way to do it because you get some growth in there. You get some, some VOO or some S&P 500, which of course will have a little lap. And if you want to go semiconductors, if you want to go a couple different ways that you can really build out that ETF portfolio. So guys, let me know what Spider ETFs you are carrying, or if you're going Spider or Vanguard, and I'll catch you in the next video.